Most people believe money disappears the moment it changes hands. You tap a card, scan a phone, or send a payment, and the exchange feels private and complete. Coffee for cash, goods for value. End of story. But that sense of finality is an illusion left over from an older world. In today's financial system, transactions don't vanish. They persist. They are logged, labeled, analyzed, and stored. What looks like a simple purchase is actually a data event, one that feeds into a system far larger than any individual bank or business. The assumption that governments only care about financial activity when it involves obvious crimes is outdated. Financial monitoring no longer targets only traffickers, fraudsters, or organized crime. It now captures ordinary people by default. The system isn't built to identify rare bad actors hiding in the shadows. It is designed to illuminate everything, everywhere, all the time. In that environment, innocence doesn't exempt you from scrutiny. Participation alone is enough. This shift did not happen overnight. It began decades ago, quietly and legally, when financial privacy was reframed as a liability rather than a right. Before the modern era of compliance, banks were expected to safeguard customer confidentiality. That expectation changed when governments realized banks could be repurposed as extensions of the state. Laws were introduced that required financial institutions to report certain activities automatically, not because a crime had been proven, but because a threshold had been crossed. At the time, those thresholds seemed reasonable. Large cash movements were rare and typically associated with serious criminal behavior. But the numbers never adjusted as the value of money declined. Inflation did the work silently. What once signaled extraordinary wealth slowly became ordinary life. Over time, the same reporting rules that once targeted kingpins began capturing retirees, small business owners, contractors, and families. Without rewriting a single law, the scope of surveillance expanded until it covered the middle of society. What made the system more powerful was not just mandatory reporting, but intent-based enforcement. Avoiding scrutiny itself became grounds for suspicion. Actions taken to preserve privacy were reclassified as red flags. Perfectly legal income, handled carefully, could now trigger penalties not because of what the money was, but because of how it moved. In this framework, privacy stopped being neutral. It became evidence. After major global security shocks, financial oversight accelerated further. Identity verification was embedded into nearly every financial interaction. Opening an account, sending money, or accessing platforms now required documentation, biometric confirmation, and ongoing behavioral analysis. Money ceased to function as a simple bearer instrument and became inseparable from identity. Each unit of value was tied to a person, a profile, and a risk score. This transformation allowed discretion to shift away from courts and into algorithms and internal compliance teams. Reports could now be generated based on subjective judgment rather than clear rules. Unusual behavior, vague patterns, or transactions that didn't fit could all be flagged. Once flagged, individuals were rarely informed. They entered invisible systems that influenced how banks treated them going forward, often permanently. The psychological effect of this environment is subtle but profound. When people don't know where the lines are, they begin to police themselves. They change their behavior not because it is illegal, but because it might look wrong. They hesitate, they simplify, they avoid anything that could attract attention. Surveillance doesn't need constant enforcement when uncertainty does the work on its own. As physical cash declined, digital rails became unavoidable. Governments and financial institutions openly framed this as progress. Faster payments, cleaner records, improved efficiency. But digital systems also eliminate frictionless anonymity. Cash allows direct exchange without witnesses. Digital payments require intermediaries, servers, and logs. Every step introduces visibility. Restrictions on cash usage spread quietly. Limits were imposed on how much could be spent, withdrawn, or accepted. High-denomination notes were removed from circulation. Entire economies were nudged into systems where opting out became impractical. Once transactions are forced onto digital rails, comprehensive visibility becomes unavoidable. At the same time, fiscal pressure mounted. Governments facing growing deficits began searching for revenue not by raising rates, but by expanding visibility. Informal income, side work, and peer-to-peer payments were reclassified as taxable data streams. Platforms were required to report activity at much lower thresholds. What had once been considered personal or incidental now fed directly into tax enforcement systems. Surveillance alone, however, is passive. The more consequential shift occurs when data is used to deny access. Financial participation is no longer guaranteed by citizenship or legality. It is conditional. Accounts can be closed, services withdrawn, and access revoked without criminal charges or court orders. This practice, often justified as risk management, effectively determines who is allowed to function economically. The mechanism is indirect but effective. Regulators signal preferences. Banks adjust behavior to avoid scrutiny. Entire industries can be pressured out of the financial system without legislation. When private institutions enforce public goals through contractual terms, constitutional protections no longer apply. The result is control without accountability. Political, social, and reputational factors now influence financial access. Views, affiliations, or associations that fall outside accepted norms can quietly become liabilities. When one major institution exits a relationship, others often follow. The individual is not prosecuted, they are simply excluded. This is no longer theoretical. Public examples have demonstrated how quickly accounts can be frozen or closed during moments of political tension. In some cases, participation alone, donations, associations, or support was enough to trigger restrictions. The consequences were immediate and severe: inability to pay bills, access savings, or participate in basic commerce. Once money exists only as a digital permission, it can be revoked instantly. Ownership becomes conditional. Value remains on a ledger, but access depends on compliance. In such a system, survival itself can be regulated. The logical endpoint of this trajectory is fully state-issued digital currency. Unlike current digital money, which exists as a claim on a private institution, a central bank digital currency places individuals in direct relationship with the state. The intermediary buffer disappears. Control becomes centralized. Programmability is the defining feature. Money is no longer neutral. Conditions can be attached. Limits can be enforced automatically. Spending categories can be restricted. Funds can expire. Behavior can be incentivized or discouraged directly through currency design. Economic policy becomes behavioral policy. Consumption patterns can be guided. Savings can be penalized. Movement can be constrained through geographic rules embedded in transactions. Compliance no longer requires enforcement after the fact. The system prevents non-compliance in advance. These capabilities are not speculative. Pilot programs already exist. Digital currencies have been tested with expiration dates, spending controls, and real-time oversight. Adoption strategies rarely rely on force. They rely on incentives, convenience, and crisis. Emergency payments, benefits, or relief are framed as solutions, offered through new systems that gradually replace older ones. Once dependence forms, alternatives disappear. Cash fades. Private rails shrink. Opting out becomes impossible without exiting the economy itself. The justification is always framed as protection, efficiency, inclusion, stability. But control is the consistent outcome. The more detailed the data, the easier it becomes to manage populations rather than serve them. History shows that financial power has always been a tool of the state. When circumstances demand it, laws change, assets are seized, and rules are rewritten. Technology does not change that impulse. It only increases its precision. The future of money is therefore not just a technical question. It is a political and moral one. A society that cannot transact privately cannot dissent meaningfully. When every action is visible and conditional, freedom exists only until revoked. The most effective resistance is not dramatic. It is mundane, using alternatives where possible, preserving optionality, valuing privacy over convenience, understanding that efficiency is never free, and that data is never neutral. The systems being built today will define how much autonomy exists tomorrow. Financial tracking is not the end goal. It is the foundation. What is built on top of it will determine whether money remains a tool for exchange or becomes a mechanism of control. Hey everyone! If you enjoyed this video and want to stay updated with more insights on finance, make sure to subscribe to my channel, Financial Coin. And don't forget to hit that bell icon so you never miss our latest videos.